You're listening to Nora and Noah Decode the Day, where markets meet meaning every morning.
Welcome to the deep dive. You sent us some really interesting stuff about gold recently.
Yeah, that whole price surge.
Yeah.
Hitting record highs.
Exactly. And the sources linked it to, well, President Trump's tariffs, the hunt for safe investments, some even drawing parallels to Bitcoin, which is fascinating.
Right. That comparison keeps popping up.
So our mission today, basically, is to dig in and see if this rally has legs. Can it last? We'll be looking at analyst insights and especially what the options market is telling us.
Okay, sounds good. Where should we start?
Well, maybe with that massive options trading activity. You mentioned the SPDR Gold Shares ETF.
Ah, yes. When gold hit that record peak, trading on the GLD, that's the ticker, just exploded. We're talking over 1.3 million contracts traded.
Wow, 1.3 million. That's huge for an ETF tracking gold.
It really is. And what was weird, or at least unusual, was happening alongside it in the options pricing itself.
Unusual how? What do you mean?
Well, okay, so the cost to hedge against gold falling, buying puts for protection, that cost was actually near its lowest since last August.
So insurance was cheap, relatively speaking.
Exactly. But at the same time, the market's expectation of future price swings, what we call implied volatility, that had spiked up.
Huh. That seems counterintuitive. Usually if volatility jumps, protection gets more expensive, right?
Generally, yes. People weren't paying up for downside protection, but they were pricing in bigger overall moves.
So maybe expecting big moves, but not necessarily downwards? Or maybe more focused on upside potential?
That fits with what Tanvir Sandhu over at Bloomberg Intelligence pointed out. He called it a spot-up, vol-up dynamic.
Spot up, vol up.
Yeah, price goes up, and expected volatility also goes up. He noted it in both gold and Bitcoin, actually. Said it was similar to what we saw with some big tech stocks, the Mag 7.
Driven by people buying calls, betting on more upside.
Precisely. A surge in demand for calls pushed up that implied volatility. Though Sandhu did add that after gold dipped recently, that volatility expectation spread out more evenly across different potential prices.
Right, which brings us to that dip. Gold's fallen, over 5% from that peak?
Yeah, a noticeable pullback.
Does that mean the rally's fizzling out? Maybe those easing trade tensions are calming things down?
Could be. That's one interpretation.
Yeah.
And we also saw hedge funds cutting back quite significantly on their bets that gold prices would keep rising. Their net long positions dropped.
Okay, so the initial drivers tariffs, maybe this idea of U.S. exceptionalism fading, pushing money to gold might be weakening.
That was certainly part of the narrative for gold outperforming treasuries and U.S. stocks for a bit. But strategists at Barclays are urging a bit more caution.
Caution? Why is that?
They feel the rally might have gotten ahead of the underlying fundamentals, the core economic reasons for gold to rise.
Like interest rates or currency movements.
Exactly. And they also pointed out that, yeah, central banks have been buying gold, but it's not really out of line with long-term trends when you zoom out. Nothing unprecedented there recently.
And Barclays mentioned speculation too, didn't they? Especially around certain political comments.
They did. Stefano Pascal at Barclays highlighted a big jump in call buying on that gold ETF right after President Trump's Liberation Day comments.
Oh, okay.
He said the speculation was so intense, it actually inverted the options skew.
Inverted the skew, meaning?
Normally, options protecting against a price drop cost more than options betting on a price rise. An inversion means the calls, betting on the price going up, became unusually expensive relative to the puts. It shows, extreme demand for upside bets.
Got it. So Barclays sees that, plus the hedge funds pulling back, plus the price drop itself, and they're wary.
Yeah, they think gold prices might be dislocated, was the word used, from things like the U.S. dollar and real interest rates. And they mentioned the technicals starting to be a little bit stretched.
Stretched technicals, like it went up too high, too fast on the charts.
Pretty much. It suggests the momentum might be overdone in the short term. Pascal basically suggested they see potential for a pullback.
Okay, so that's a pretty cautious, maybe even bearish short-term view from Barclays?
It is. But then you've got folks like Garrett DeSimone at Option Metrics. He has a different read.
Oh, what's his take?
He actually leans into that Bitcoin comparison. He sees similarities in how both are trading and thinks, well, maybe both could rally further.
Really? Even after the recent dip and the warnings from Barclays, why?
His argument is based on the options market again. He says that the implied volatility and the skew while maybe unusual, like Barclays noted, are still within their historical ranges for both gold and Bitcoin.
Meaning the market isn't pricing in anything completely crazy yet. It's seen these kinds of conditions before.
Kind of, yeah. He suggests the options market is still showing relatively balanced expectations for upside versus downside moves compared to history. Not necessarily screaming overheated yet, in his view.
Interesting. So Barclays sees dislocation in stretched technicals, while Option Metrics sees patterns still within historical norms, suggesting potential for more upside.
Exactly. Two quite different interpretations of some of the same data points.
And Barclays even recommended a specific trade based on their caution, right?
They did. A zero-cost risk reversal. Basically, sell Jim call options betting against a big rise and use that premium you collect to buy put options betting on a decline.
A clear directional bet that gold will fall, even though you mentioned their own indicator is still technically bullish.
Right. The proprietary indicator might still be positive overall, but they see enough warning signs, the hedge fund positioning, the price action, the skew, to recommend this strategy, hedging against or betting on a drop.
Okay, so wrapping this up, we've got a real mix of signals here. On one hand, warnings about stretched fundamentals, speculators getting maybe too excited, and big players like hedge funds reducing their bets. That points towards caution, maybe a downturn.
Definitely the case for caution.
But on the other hand, you have analysis suggesting the options market, while active, isn't necessarily showing extreme panic or euphoria yet compared to its history, potentially leaving room for gold, maybe like Bitcoin, to climb higher.
That's the counterargument, grounded in how the options market is pricing risk right now.
So it really leaves us, and you listening, in an interesting spot. You've got these conflicting signals. You've seen how sensitive gold can be to things like trade policy and global economic sentiment. The question really becomes,
what factors do you think will ultimately win out? What's going to drive gold's next significant move from here? It's certainly not a simple picture.
That's it for today's Decode. If you found this helpful, make sure to subscribe, and we'll catch you tomorrow, right here on Nora and Noah Decode the Day.